Thank you for coming to our workshop. This workshop is designed to help you take advantage of tax deductions while maintaining your profit margin in order to get approved on loans. Businesses are in a constant struggle to reduce taxes and receive approval for loans. Oftentimes, we will reduce our tax liability by investing in business expenses and ensuring all our deductions are being taken. This lowers our net income and then lowers our tax. However, banks want a high net income. Yet in order to reduce taxes, we need a low net income. What can businesses do to solve the tax situation and the bank situation at the same time? This workshop will show you how. First, let's look at how banks decide on loans. First thing that a bank will look at is your credit history. The higher the credit score, the better chances you have at loan approval. Additionally, the interest rate is based on your credit score. Generally, anything above 720 is a good credit score. Below that, your interest rate increases and your loan approval decreases. They also look at the business history. The longer you're in business, the better chances you have at loan approval. Banks also like to see net income in the last 3 out of 5 years. They don't like to see a loss. What will the funds be used for? At this time, any funds being used for anything other than to buy an asset, loan approval is very slim. Banks like to have security for the loan. If you buy an asset, for example, a copier or a refrigerator, then the bank knows if you fail to make your payments, they can repossess that asset and sell it to someone else in order to satisfy a part of the loan. This is called a secure loan. Generally, you will not get a loan unless it is secured. A line of credit for just cash is very hard to get at this time unless it is secured by an asset of some sort. It does not have to be the asset you're buying. For example, you can get a line of credit for $10,000 that is secured by your vehicle if your vehicle has no other loans on it and has a greater value than $10,000. What is the net income from the business is another issue that banks look at, and they modify that net income by depreciation. Banks will only modify the net income by the depreciation that was taken. They won't modify your net income by anything else. We're going to talk more about this in a moment. Now that we understand where banks are at, we need to look at our tax return and understand our tax return. And there's different methods you can do to reduce your tax burden. First, you can reduce your sales. Obviously, reducing sales is a bad option. However, it will reduce your tax liability, but it's definitely not a suggested option. Be sure all tax deductions are taken. Many businesses lose their receipts because they do not have a good method to track all expenses, especially receipts paid with cash. If you do not have an accountant or your accountant is not doing a good job, you could be missing out on possible deductions. So by improving your accounting method, you could actually get more deductions and lower your tax. Having an accountant with tax background or having tax knowledge yourself will help the business reduce its tax burden. For example, your business could take advantage of investing in retirement plans in order to save on costs, or take advantage of new laws that help businesses save on taxes. Tax laws change every year, and if you're not aware of the changes, you could miss out on deductions that could help you. A couple of years ago, there was a program for hiring new employees where the government reimbursed businesses a portion of their payroll costs. Without a good tax preparer, many businesses missed out on this reimbursement. You could also invest in necessary assets. Assets are any items you would purchase that can be used for more than 1 year. A computer would be an asset. Flour for making bread would not be an asset. The key here, though, is necessary assets. At times, businesses will invest in assets they do not need in order to reduce tax liability. This is a bad idea. A business might buy something they do not need for $1,000 and will only save $400 in tax. This causes the company to lose $600. Obviously not a good idea. Just to save on $400 in tax, you spend $1,000. If it's an item you didn't need, that was kind of silly. Let's take a look at a comparison if we reduce our tax and the bank's response to our methods for reducing tax. So first, we talked about reducing sales. How does the bank feel about reducing sales? That's a negative. And the reason why it's a negative is it shows the business not doing well. Again, we talked about reducing sales is not a good or realistic option, But if you were to reduce sales, then the bank would see this as a negative. You could increase your deductions, but if you do that, this again is a negative. If you increase your deductions, this lowers your net income. The bank takes your income into consideration when determining the probability and ability for the loan to be paid back. If your income is too low, then you will not have cash available to pay back the loan. So if you increase your deductions and lower your income, your loan could be denied due to lack of funds available to pay back the loan. We could invest in necessary assets. The bank's response to that is a positive response. Banks realize that the purchase of the asset was a one-time expense, not an ongoing expense. When the bank reviews your income statement or profit and loss, they will realize the depreciation was not an actual expense, but a government-allowed deduction for purchasing a new asset. Since it was not an actual expense and will not be a reduction out of your bank account, they will add it back to your income. Now that you have an understanding of what banks are looking for and what methods are available for lowering your tax, let's use that information to focus our efforts on what will benefit the business the most. Investing in necessary assets is the best method for reducing your tax burden and maintaining loan approval. We will focus on that method here. Remember the slide, Understanding Banks? We mentioned that net income is modified by depreciation. I don't want to make this too confusing, but by focusing your business deductions on this area of investing, you can lower your taxable income and still not reduce your loan approval. This gives you the best of both worlds. You're going to get tax reduction and loan approval. So the effects of investing in a necessary asset: your business obtains a necessary asset that's going to improve operations. The asset is added to your balance sheet, but does not reduce your profit and loss statement. The exception here is depreciation. But that doesn't matter because the bank is going to add back the depreciation. So you're going to get the tax benefit of having the asset, but you're not going to see your loan approval go down. Now let's take a look at the next slide to see what we mean by the balance sheet, profit and loss, and depreciation being added back. If we take a look at this example, on the left we have a balance sheet, and on the right we have an income statement or profit and loss for Logistics LLC. The balance sheet is a simple list of all the assets and liabilities of the business. The income statement or profit and loss is how much money the business made or lost. Logistics LLC has bought a new forklift. If we look at the balance sheet, we can see that the asset has a value of $45,000. Again, I don't want to get too technical. I just want to keep this as basic as possible. But if we look on the left-hand side, we can see that $45,000. This is the amount they purchased it for. We can also see that they depreciated the forklift all the way by taking advantage of a law called 179 expense. So see on our right-hand side on the income statement or profit and loss, we see the depreciation expense of $45,000. Their net income, the amount that they're going to pay tax on, is $49,664.32. However, the banks looks at this differently than the IRS. The IRS is going to look at that number and you're going to pay tax on that number. The bank will add back the depreciation amount of $45,000 when considering loan approval. And now the bank will have net income of $94,664.32. Remember, the bank will add back the depreciation because they realize this was an ongoing expense. It was a one-time tax benefit charge. This is the perfect situation. Now that you have seen the effects on purchasing necessary assets, let's look at some other benefits of purchasing assets. When a business considers purchasing a necessary asset, they not only benefit the loan approval process, but it also opens up the door for the tax preparer to have flexibility on preparing the tax return. The asset can be partially deducted, it can be fully deducted, and the government tends to pass legislation encouraging special deductions for assets purchased. The special depreciation is not always available. It depends on what the president passes as to what type of special depreciation is allowed. But we do see this from time to time. So beyond the loan approval, there is obviously other benefits to buying a necessary asset. In summary, this workshop was designed to give you knowledge on how best to financially position your business. It is not always possible to invest in assets. There are other expenses that businesses must incur in order to operate. However, by being aware of what banks are looking for and how best to invest in order to save on taxes, you encourage long-term growth of your business. This year, consider consulting with your tax preparer before making any purchases. Be sure to tell them your goals and what your plans are for your future. They should be able to help you determine the best deductions to take. There are other options to reducing your tax liability while maintaining a high income for loan approval. Check with your tax preparer or accountant annually for any tax law changes that may benefit your business. You can also research that information your own at the IRS website. Thank you again for coming out for this workshop, and we hope that it was informative and helps you run your business better.